The probability brief for Wednesday, March 4, 2026, the variance of velocity, asymmetric information and the second-order squeeze. Welcome to the probability brief, the signal check on the world's most telling prediction markets. Today is Wednesday, March 4, 2026. The probability brief's objective is to deliver clear, data-driven intelligence on how major events are being priced in real time. Each episode examines fast-moving prediction markets, high-impact whale trades, regulatory momentum, and shifts in crowd psychology. The show explains what moved, why it changed, and what the probabilities reveal about the path ahead, making complex market signals accessible, actionable, and easy for listeners to follow. In today's briefing, we move past the surface headlines to dissect the mechanics of market memory and the incentive maps currently redrawing the lines in decentralized infrastructure and biotech adoption. We are tracking a unique convergence, a volatility cluster in the energy markets meeting a sudden information asymmetry in the regulatory pipeline. Signal mechanics, the velocity of rumor versus the friction of fact. We begin with signal mechanics, where we look at how a signal propagates through the noise. Overnight, we observed a classic narrative contagion in the markets tracking the 2026 European Trade Accord. At 1 a.m., a rumor began circulating on encrypted messaging channels that a key delegate had walked out of negotiations. Within 40 minutes, the probability of a signed agreement by April 1 dropped from 74% to 41%. What is fascinating here is not just the move, but the signal velocity. A rumor moves at the speed of social media, but fact-checking moves at the speed of institutional bureaucracy. This creates an information gap where sophisticated traders can exploit the delta between panic and reality. In this case, the walkout was purely procedural, a lunch break that was mischaracterized by an intern's social post. While the retail crowd sold their yes positions in a panic, the whales remained silent. When the whales don't move during a 30-point swing, it's often a signal that the move is hollow. By 6 a.m., the market had fully retraced to 72%. This episode illustrates why a poll or a tweet might move the odds temporarily, but only high-conviction liquidity, the actual capital of informed players, sets the long-term price. Market microstories. The 2 a.m. synthetic squeeze in biotech. Our market microstory today takes us to the niche probability ecosystem of FDA orphan drug designations. At 2:14 a.m., we saw a sudden, sharp 5% reversal in a market tracking a specific respiratory treatment. On the surface, 5% is minor. However, the microstructure reveals a synthetic squeeze. A hedge fund had been accumulating no contracts as a hedge against a pharmaceutical stock position. When a small, independent research blog published a positive peer review study, the yes side saw a sudden influx of liquidity. This forced the hedge fund to buy to close their no position to prevent a margin call on the prediction platform. This microcorrection serves as a teachable moment. In niche markets with low liquidity, the price isn't always a reflection of truth. Sometimes it's just the sound of a large player being forced to the exit. Structural context. Pricing the adoption curve of fusion. In structural context, we look at how markets price the impossible. Last month, we discussed the liquidity drift in renewable energy. Today, we focus on the sudden repricing of fusion adoption curves. Following a technical breakthrough in magnetic confinement announced yesterday, the fusion power on grid by 2035 markets shifted from a 3% long shot to a 12% serious contender. Traders aren't just pricing the tech. They are pricing the regulatory path. When a tech breakthrough occurs, the market first prices the discovery, then the scaling, and finally the opposition. We are currently in the scaling phase. The probability of federal subsidies being redirected from traditional nuclear to fusion research has jumped to 45%. This creates a volatility cluster in utility stocks as the market struggles to decide if fusion is a threat to current infrastructure or a savior for future demand. The structural context here is that the market is beginning to price fusion not as a science project, but as a geopolitical asset. Regulatory trajectory analysis. The committee dynamics of DeFi. In our regulatory trajectory analysis, we move away from the if and look at the how. We are currently tracking the Senate Banking Committee's internal dynamics regarding the Stablecoin Reserve Act of 2026. By interpreting agency signals. Specifically the recent public comments from 3 swing vote senators, we can see a shift in the incentive map. These legislators are moving toward a compromise that favors established banking incumbents over pure-play tech startups. If we compare this to the historical analog of the 2011 Durbin Amendment, we see a pattern. The pre-draft sentiment is always more aggressive than the final rule. Market participants are currently front-running a harsh regulation that may never arrive in its current form. The true signal is in the lobbying spend. When the major fintech players stop publicly fighting and start quietly coordinating, it's a sign that the regulatory floor has been set. Crowd Psychology Deep Dive, the confirmation cascade in Mars Logistics. Crowd psychology is often the most distorted lens in the probability ecosystem. Today's deep dive is on confirmation cascades within the commercial Mars cargo markets. Currently, the yes contracts for a 2026 launch are trading at an 82% probability despite 2 recent static fire failures. This is a classic case of narrative anchoring. The crowd is so invested in this success narrative of the primary launch provider that they treat every failure as a learning opportunity rather than a data point for a delay. This attention scarcity, where the crowd only has the bandwidth for one hero narrative, suppresses the very real risk of a mission scrub. When a market becomes a fan club, the price loses its predictive power and becomes a measure of sentiment. This is where the highest alpha exists for the objective observer. Market memory, the echo of the 2024 energy crisis. Prediction markets have long memories. In our market memory segment, we look at how the energy markets are reacting to current supply constraints by looking back at the winter spike of 2024. During that cycle, markets overcompensated for a late-season cold snap, pricing in a 90% chance of a blackout that never occurred. Today, we see a persistent narrative where the market is pricing a 15% risk premium on any energy contract simply because of that past trauma. Traders are anchored to the memory of the 2024 failure, leading to a mispriced hedge. The current infrastructure is 40% more resilient than it was 2 years ago, yet the probability of a systemic failure remains at 2024 levels. Market memory is creating a safety buffer that actually represents a profit opportunity for those who trust the new data over old ghosts. Cross-market correlation, the semiconductor agriculture link. One of our most sophisticated signals is the cross-market correlation. We have observed a developing link between advanced AI chip lead times and precision agriculture adoption in the Midwest. When Market A, chip lead times, stretches beyond 6 months, Market B, automated harvester rollout, sees a 4% drop in Q3 implementation probability. This is a second-order effect. The automated tractors require the same high-end logic chips as AI servers. Because the server market has higher margins, the agriculture sector gets deprioritized in the supply chain. If you are watching the grain markets, you should actually be watching the semiconductor foundries in Taiwan. This is a high-value signal because it bridges 2 seemingly unrelated domains through the lens of shared hardware incentives. The incentive map, the silent exit of carbon credits. In the incentive map, we ask, who is silent? We are currently seeing a strange divergence in the global carbon credit offset markets. While the public yes price remains high, the liquidity flow shows a quiet exit by major European industrial firms. These firms are the informed stakeholders. Their silence in the public debate, while they quietly offload their 2027 dated credits, suggests they anticipate a regulatory pivot that will render these specific credits worthless. The incentive here is to maintain a green image publicly while de-risking the balance sheet privately. If the coordinators are selling while the crowd is buying, the outcome is almost always a narrative collapse once the new regulation is formally filed. What traders missed this week, the quiet filing in desalination. Finally, we look at what traders missed. While the world was focused on a high-profile tech CEO hearing, A quiet regulatory filing from the Bureau of Reclamation regarding inland desalination brine standards slipped through. This is an undervalued signal. This filing changes the cost basis for water tech startups in the Southwest by nearly 30%. It's an early sign of narrative decay for the current batch of desalination companies. The probability markets haven't reacted yet because the attention cycle is elsewhere, but the microstructure shows a subtle shift in the bid-ask spread for these companies. This is the definition of signal-first intelligence, finding the move before it becomes a headline. Episode summary and closing. In summary, today's market signals illustrate the power of second-order effects. We saw how a lunch break rumor can trigger a 30-point swing, how a synthetic squeeze can distort biotech truth, and why the silence of industrial giants in the carbon market is a louder signal than any press release. We learned that market memory often creates a risk premium that doesn't match the new reality and that the incentive map of semiconductors is now driving the future of agriculture. To stay ahead, you must watch the plumbing, the supply chains and regulatory filings, where the true probabilities are formed long before the crowd arrives. Thank you for listening to the Probability Brief. If you found this valuable, please like, subscribe, follow, and share with someone who watches the odds like you do. The sources for today's episode are Polymarket, the Bureau of Labor Statistics, Twitter Trends, and Senate hearing transcripts. This podcast is for informational purposes only and does not constitute financial, investment, or betting advice. All market probabilities are subject to change. Episodes may be generated using fully original, market movements, whale trades, regulatory signals, geopolitical dynamics, and probability ecosystem behavior. Some scenarios, market movements, or examples discussed in this episode may be illustrative or simulated for explanatory purposes.